Well, good afternoon, everybody. My name is Brett Augustine. I'm an advisor for the North Central Texas Small Business Development Centers, a leading provider of assistance for small businesses. We are grant funded, which allows us to offer these services and these webinars at no cost to you. If you have any questions today, if you would, please just put them in our chat box and we'll be happy to get to them as we go or at the end. And today we're very, very blessed. We have Miss Rebecca Schultz, and she's going to be presenting financial bookkeeping for business funding needs. And all of you should pay attention to this if you're looking for funding, because I have a feeling she's going to give us some techniques and some things that we need to think about to make that easier. For those of you that don't know Rebecca, she is the I apologize. Rebecca Schultz is the founder of
Centerlock.
Thank you,
Centerlock.
Centerlock. You know what? I'm going to start over and I'm going to edit all of this out, okay? And it's only because I don't see all of the wonderful information I normally have about you right there on my script today. So I had to do that. So here we go. We're going to start over, okay? Good afternoon, everybody. My name is Brett Augustine. I'm a recovery business advisor for North Central Texas Small Business Development Centers, which is a leading provider for assistance for small businesses. We are grant funded, which allows us to offer services at no cost to you, including these webinars. Today, we're accompanied by Ms. Rebecca Schultz, who will be presenting financial bookkeeping for small business funding needs. We're looking forward to that. If you have any questions along the way, please put them in our chat box, and we'll be happy to get to those as we go through the day. And with that, I'm going to allow Ms. Rebecca Schultz to give a brief introduction of herself and allow us to enjoy her presentation for today. Thank you, Rebecca.
Thank you, Brett. My name is Rebecca Schultz, and I do love money, right? That leads me to this conversation today, talking about bookkeeping for small businesses, right? And those small businesses that are looking to get money themselves in order, hopefully, to grow the company and, well, have a good time, right? That's what it's all about. So I'm going to go ahead and start sharing the presentation. Hang on one moment. And just confirming I need to switch the slides. Is that correct? Yes. Okay,
I
you're only
think you're
seeing.
good right there.
Oh,
Nope, you were good right exactly where you were.
all right, all right. I'm gonna flip it
You,
again. Thank you.
you bet.
Okay, all right, team. So
Perfect.
yes, we're talking about bookkeeping for funding needs. It's kind of a nuanced conversation, right? I feel like we get into shades of this conversation through other topics, but this is going to be specifically about understanding how you pull together the right documentation in order to have the conversation you want to have with the lender. All right. So get ready. We're gonna go for a wild ride here. All right. So I told you about myself. I do love money. I have over 25 years of lending experience. It has been my career, right? And with that, I have really focused on helping business owners understand capital, right? Get capital in order to grow and support their businesses. Now, I myself am a small business owner, right? I've had multiple business. I understand what it's like to be in the business owner's seat. But I also have this rare chance of being in the lender's and underwriter's seat. So I'm going to try to bridge the conversation between both parts. All right, I do like to have fun, right? And so I saw this little meme and I wanted to share it with you today, right? He's crunched the numbers. This month is going to be rough, right? So as we crunch our own numbers, we're going to go ahead and start to learn how you have that conversation with a lender or an investor. Now we really focus on bringing to light what's most important. Okay. All right. So I've divided up the conversation really into four parts with the summary. All right. Really easy to understand. The first part is understanding historical numbers, their value that they bring to the conversation. I'm going to give you a little analogy in a few minutes. You will never forget this conversation when I give you the analogy. It's just that good. All right, then we're going to talk about financial details that are important to lenders. All right, as we're preparing this conversation, right, we're getting these records or bookkeeping prepared. We're understanding that we're preparing it for a specific type of conversation. right? And they like to be talked to in a certain way, right? It's almost like if we were to go, let's say, to a restaurant, right? And maybe it was a Mexican restaurant or it was a Japanese restaurant, right? We want to be able to speak the language we understand, right? We might not be so good at calling off the names on the menu, right? I'm making you learn the language of the lender and be able to understand how this information transfers over, what they're actually looking for, okay? Then we're going to switch over to being able to talk the lingo, right? Frame the conversation with the needs and how we're supporting the documents or the records. I think that's the where the rubber meets the road. That's where you're actually able to communicate, right? Framing your need with the right reports. So we'll spend quite a bit of time on that conversation. And then, the world isn't always about historical numbers, right? It's about understanding the future and what you're able to make happen when you've got the right financial support, right? So I call that living in the world of financial projection. So we're going to be learning how to explain what we need through the projection conversation. And it's really the whole of this, right? All four pieces working together that helps you understand what really is that bookkeeping need, right? To communicate to the lender or the funder. All right. So that's fun, right? It sounds boring, but it's fun. So let's get going. All right, so I talked a little bit about understanding that there is a conversation happening and that we're preparing information for a specific type of person. Now, when I say that, the specific type of person, I almost feel like I am kind of profiling, right? I know, right? Ooh, I'm profiling for a type of person because believe it or not, lenders, especially when you get to the underwriting type of career, they are very much hired for a certain skill set. They are a certain type of person. And so understanding how you communicate or frame that conversation helps you have a good conversation, right? All right. So lenders want the information in a simple format. It has to be simple, right? It should be pretty easy to explain. It doesn't need to be complicated or so complicated that you can't explain it to the lender, right? Remember, simple is better, always. All right. Now, the number one reason why you're preparing this information is you're trying to gain confidence for the lender and show them how they're going to get paid back. That's goal number one. They never want to lend when they won't get the return back or get the money back. So we want to gain confidence that you'll be able to repay the loan. All right. Next, lenders, they are pattern seekers, right? So remember when you were in elementary school and it was, square, circle, you were looking at patterns, right? Lenders just grew up looking for those same type of patterns, right? So we have to understand how to follow the trends, and I'm going to help you identify those trends, really break it down so you can do this on your own before you go before a lender. Because if you can understand what the trends are saying, right, you'll be able to master the financial dialogue that goes along with that and determine what additional type of support or financial statements will need to help continue the conversation in the right path. All right, so we're going to learn how to understand those trends, right? Ask the questions about the cash flow up and the cash flow down, right? We need to understand whether or not that makes sense. It feels a little silly, right? But we need to understand, does our story, both written and oral, match the numbers, right? And does it make sense? Or is it a compelling case, right? Now, when all of this is happening, it feels a little bit like we're doing a tap dance, right? So when all of this is happening, we have to make sure that we're explaining, how the future money that we're asking for, right, is going to be used in the business because essentially it's coming in, hopefully for a purpose, and hopefully it's going to increase revenue, right? Right? We don't want to invest into a business where it's not going to make enough money and not repay us, right? So how is that money going to be used in the business? Right? And then this is like I feel like the key. And we'll talk about this in a minute because I go over the 5 C's of credit. But we're going to talk about what happens if the cash flow dries up, right? And all these trends, they don't play out. This is what we had happen at the onset of the pandemic, right? What happens if cash flow dries up and businesses don't make what they expected to make? What's next? Believe it or not, your financial conversation, these statements you're pulling together for this conversation, should help understand what's next, right? What happens if everything goes crazy? I know. All right. So, this is what we need to communicate to the lender. It feels like a tall order, okay, but it's not. It's completely doable. All right. And I just want you to remember that the numbers are going to tell the lender or the investor a story, right? And we want to align with the story that we're telling. It's like a little kid that ate the cookie, right? And he's got crumbs or chocolate all over his mouth, and he's telling the parent, like, I didn't have the cookie. Like, clearly you had the cookie, right? So the oral, the written story need to match the numbers, and you really want to make sure you have a compelling in sync conversation. So that's why you need to do the work yourself and really make sure that you are providing the reports that give the accurate story. I'm not saying a made up story. Okay, I'm not saying that you make it up. I'm saying an accurate story. A lot of times financial statements will have errors, user errors, maybe something got logged the wrong way, and they need to be corrected in order for the correct story to come across. Those are the type of things that you got to catch on your own. All right, so we're going to do a little bit of kind of statement, I guess you would say learning. I'm going to help make sure that you guys know the standard statements that are typically asked for in a package. And so I'll go into a little bit of detail for you, but you really want to know that different financial statements tell the same story, but from different angles, right? It's like we have a Netflix film happening and we've got different angles, or we've got individual characters and we're seeing the problem from their perspective. All right, and so that's why it's important that you see or learn a little bit about the financial statements and understand how that story connects to them and how it should hopefully make a compelling conversation or support to your narrative. All right. All right. So, one thing that they're trying to understand, the lenders being they, is there's risk out there. And so they're trying to understand how much risk you take on in your business and how you monitor the risk in your business. So how much you take on and how you monitor that risk, right? And then make sure that you have the leadership capacity to keep the business on track. All right. See, I'm going to clear my throat. I'm going to pause there because you and I know as business owners how much work that actually is, right? That is hard work, right? Monitoring the business, making sure everybody stays on track, making sure that your full team stays focused and stays on the mission to accomplish it, right? That is what makes a business owner great, is being able to help make things happen and stay on track. Right? Lenders, they don't necessarily understand all of that, right? What they're looking at is they're looking in from this little tiny mirror trying to judge and understand that whole conversation. And so you're going to have to help them see that you can do that. And so really, when we talk about financial statements, there's going to be different ways that you can provide that type of view, right? It may not be in a standard statement. And so I want to just open up your mindset beyond just the formal reports, right? To say that, there's ways to get to a confirmation of your story without having a standard set report. All right, so we'll talk more about that. I just want to open that up for you. This is really about documenting a case and showing that you have what it takes in order to perform. Okay. All right, that was a good story, right? All right, so now I'm going to give you that analogy that I told you that you'll never forget. For the rest of your life, you will never forget this analogy. I feel like it's that good. All right, and I'm going to start the analogy by talking about a business being a car. Okay, so we're driving down the road, right? Hopefully, there's no traffic, right? And there's clear sales, and we are able to grow fast, right? And we're just hitting that accelerator, smooth sailing, engines running. That's a good run business, and we're going fast. All right. Now, when we talk about, like, we take that analogy and we bring it back into the financial statements, when we talk about driving that car, understanding the value of the historical performance or numbers, right? This is tax returns and the financial history from the past. It's like talking about looking through the rear view mirror of that car, right? Surely you can see in the rear view mirror if somebody's going to rear end you, right? If something's going to happen. Maybe somebody's coming up too fast and they're going to hit you, or they're trying to, go around you. Maybe that's a competition, right? But you can learn quite a bit about problems from the past, from the rear view mirror. But we all understand that if we were looking in the rear view mirror the whole time we're driving the car, we could hit something, right? It's not the best way to drive, right? You got to look through the windshield, which I'm going to say in this analogy is going to be forecasting, or we call cash flow projections. Forecasting is looking through the windshield, right? Looking through the rear view mirrors, looking through the historical. So we'll talk about the windshield in a moment, but let's talk about the historical viewpoint of the rear view mirror. Well, when we look at the past, it helps us understand the trends, right? What has happened. And we can read and interpret those trends to gain a little insight into the business, right? Now, granted, without your written or oral narrative about the business, historical trends don't mean a whole lot. Right? That's why it's so critical that you know your own narrative and you know your numbers, because you're going to be a key component to making sure that investors or lenders understand what's happening, right? You need the narrative to understand the numbers. You can't just look at the numbers and get everything right. Okay? All right, so when they're looking at the historical numbers, they're looking for experience, right? So if you have experience running this business and you've been running the business for 5 years, let's say, right? You have pretty good experience. You know what you're talking about. And you know that old adage, right? Walk the walk, talk the talk, right? Experience is going to speak louder than words. It's instead of saying you're going to do something, showing that you can do it or have done it, speaks volume, right? They gain confidence in that. So understand that as you are bridging this whole future and this narrative, this number story, that you need to show that you understand what happened in the past. Maybe you've made mistakes and you've learned from them and you're using that going forward, right? But you need to have some type of experience. We're going to tie this conversation slightly into that 5 C's of credit, which I told you I'm going to get to in a moment, right? But experience is like character. All right. Current financial statements are going to show the very current health of this business. Understanding how healthy the business is right now says a lot, all right? In fact, if you don't have current financial statements, and I'll talk more about the financial statements, I promised you that, right? If you don't have current financial statements, it's questionable, how strong the company is and what's happening in the company. It certainly makes it hard to be able to communicate to others. Remember, right, we're talking their language. Right? It makes it harder to communicate to others how healthy the company is. So it's pretty critical you have that most recent financial statements. All right. So what type of trends, right, are they looking for? Remember our pattern seekers here. What are they looking for? Well, they typically hone in on what I would say 7 key points. Right. First is going to be revenue. So are you growing in sales or revenue year over year? Has revenue declined? Why has it declined, right? They don't know why it's declined. Remember, financial statements don't tell the whole story. So they're going to be asking you to share information about your experience in that business. Right, they're going to also check to see if you have any cost of goods sold, right? That's a direct product or costs to make the sales. They're going to look at the trends of the cost of goods sold. Have cost supplies gone up, right? And maybe your pricing hasn't gone up. That would be a problem. That would be a recipe for disaster potentially with losses, right? What is the trend there for the costs? How are you doing with your wages? I just got off the phone with a business owner today and we're talking in great detail and he was like, you know what, my wages have gone up extremely high and I'm really worried because when I go into this lender conversation, they're going to see that they're much higher. So we had an honest conversation about how he's had to pay his employees more in order to try to retain the talent within his business, right? And that's putting a certain crunch on his business. But again, that's part of his story. And he used to claim that and then walk through with the lender why the wages have increased and how he's getting around to profitability again. Right, expenses. And you can take that down into expense line items. They're going to be tracking it over time. So if you have all of a sudden a new expense pop up on the financial statement that's for legal fees, right? It's going to pop a question in their mind. Is there a lawsuit? Is there something bad that's about to happen? Right? Maybe it's just starting to brew. Or, right, on the flip side, maybe that legal expense is something good, like they're acquiring a business and there's more revenue that I can anticipate going forward, right? We don't know. It takes the narrative. All right, profitability. How profitable has the company been? Have they increased profitability? Has it decreased? Why? What's happening in the leadership? All right, and then taking it to a balance sheet conversation, right? Have you increased in assets? Do you have more cash now? Less cash now? Do you have more liabilities or less liabilities? What's happening? That all comes into understanding the mindset of the business leaders and then where they're trying to drive that car, right? Where they're trying to get to. Do they have the tools, the resources? Do they have the experience? Do they have the ability? Like money is gas in the vehicle. Do they have the ability to get to the destination they're trying to get? Right? All of this comes into play. So I'm going to throw some questions at you. All right. So I want you to ask yourself, and you can do this work on your own. Again, you'll get a copy of the PDF of this presentation, so you can write this down for yourself at that time. But how would you describe your business history? Okay, business history is something that a lender or an investor is going to ask you because they want to know how long you've been doing this, why are you doing this, what inspired you to do this, right? A little bit about your company, what its goals, target market is, right? Business history. All right, so how do you describe that business history? And then more importantly, how does that business history tie into this conversation? Right? What you're doing for the money, how the money's going to support you, right? How the company has performed. All of it goes together. All right, next question. What has gone well for your business in the past? I always like to start off with the positive. All right. So much easier. The momentum is so much easier. You don't want to go from the negative to the positive, right? Start off with the positive. So, what has gone well for the business? Well, maybe you have been able to find your target market. You've done well in that target market, right? You have customers that are willing to come to you. I don't know what the conversation looks like for you, but hopefully you'll be able to understand your strengths. All right, and then you'll flip it on the other side, right? What has not gone well for the business, right? What have you learned? Take that as you know, education, right? It might have cost you something, right? But education costs you in this country. So what has not gone well? But again, what have you learned from that experience you can bring in to any future with the business? All right. And then what decisions have you had to make, right? And why? That is probably the most nuanced aspect of any future borrower or lender conversation, right? What decisions as a leader have you had to make and why? You'd be amazed at what goes into that conversation, right? You learn a lot about the business owner and what makes them tick and how risk adverse or risk tolerant that business owner is by the decisions they made, right? A lot of business owners have great conversations right now just coming out of the pandemic, right? They made tough decisions. Hopefully, they were looking at some information in their business to make these decisions to help run it, operate it, organize, and communicate within their team, right? That's part of the number story. And then this is one that you're ever evolving on. So when I say it, if you're not doing it, don't worry. Don't judge yourself harshly. But you want to start really owning this is how do you track your business's performance? If anything, hopefully by the end of our talk today, you'll have a new perspective on the rear view mirror conversation and the windshield conversation, right? And you'll be able to think about how you're really monitoring the health of your business, getting to where you're trying to get by using these type of financial statements or reporting, we'll say financial bookkeeping, to operate your business and to communicate within it. All right. So how are you tracking your performance? There's information there. It's all around us, right? We should be able to use that as a leader to make decisions. And we should be able to point to that type of leadership and decision making through the records, the financial bookkeeping that we have. Right? So it's all connected. So how well are you using that to your advantage, both for yourself and for your team, and to communicate with any third parties like lenders? I'm going to just be honest, like most of us can do a better job on that. All right. And if I'm being 100% honest, that's going to change and it can change rapidly. And we have to keep up with the change. Otherwise, we may not be the best leader for the business. It's a hard, cold truth there. Okay, so I told you earlier I was going to get everybody on the same speed with kind of the financial statements and what you get out of them. So we're going to do that now. All right, I'm going to allude to this in the future, right? So as we go through the presentation, I'm going to come back to this slide. All right, this one slide here saying the typical financial statements used. All right, so when I talk about the typical financial statements used, this is going to be what I would call the basic loan package. This is the basic package that everybody needs in order to apply for funding. This is the basic conversation you want to have with a lender investor when you go for funding. And then every business is unique, right? You will add to this basic package after you understand your conversation or your money story, right? To help illustrate or drive home specific parts because you understand more of that leadership, the why behind it, maybe the uses of funds that you need to document, the forecasting, right? You will add to this based on your unique conversation, but this is the basic, this is the core. All right, so it includes 3 years business tax returns. Okay, I told this to a business owner earlier today, and I don't think he understood, but I'm going to tell it to you, and hopefully it lands, okay? Tax returns are important to lenders because they feel, it's not always the truth, right? But they feel as though they are more real or verified than just a QuickBooks, what we call compiled financial statement. So for some businesses that have had ups and downs over the last few years, and let's just face it, that's most of us, okay, ups and downs, right? They're going to be looking for the filed tax returns because they're going to feel more confident that that's actual information they can trust rather than just a made up statement, right, by somebody who's desperate for money. Okay, so that's why you need tax returns. Now, if you're concerned because you've been in business for 2 years and you see that I've put 3 years here, you're like, I can't go for a loan for 3 years. I have to wait another year. Please ignore that. They want up to 3 years. So if you only have 2 years, then grab your 2 years and take it to the lender. I'm not trying to tell you that you need a full 3 years. But if you've been in business for 10 years, they don't typically want all 10 years worth of tax returns. They'll only want the most recent 3. Okay? All right. And then 3 years profit and loss statements, otherwise known as income statements. Profit and loss income statement, same thing. Okay? It's going to show the revenue minus expenses and the profitability of the business. All right? Then they're going to also want 3 years balance sheets. So it's a drop in time. We'll talk about that in a moment. But 3 years, if you've got a full 3 years, if you've only been in business for 2 years or 1 year, right, you only show what you have, but no more than 3 years. And then 3 years cash flow statements. The funny part is I talk about these financial statements all day long. I feel like I live and breathe them. But when I talk to business owners, they are familiar with the profit and loss statement. They might be familiar with the balance sheet, not as much, but they have no idea about a cash flow statement, right? They don't typically pull that statement. This is a standard statement in your bookkeeping, right? And the cash flow statement tells us so much about what's going on in that business. I'll share with you in a minute because we're going to break it all down, but definitely want to take a look at that cash flow statement. All right, so we've got the past 3 years, right? And then we start looking at what we call mid-year. That means it's not a complete year, but it's where you are right now, up to the last closed business month, typically. So we call that interim. So you want the interim profit and loss statement, interim balance sheet, and interim cash flow. And that will give us, really close to the like right around the corner, like the last month, how the company was performing. Okay. All right, so remember, you're going to reference this in the future. We'll come back to it, but we call it typical financial statements used. That's the core for our statement. But I did want to go ahead and, again, give you an idea of, well, what's going on those financial statements. What kind of information are they getting from it, and how do those lenders or investors use this information? So we'll start with what I believe most business owners are comfortable with, and that's going to be the profit and loss statement, otherwise known as the income statement. Okay, so remember, the profit and loss or income statement, it covers a range of time, right? It doesn't cover the entire life of the business. It's typically for a period of time, like a year, right? You could say January 1st through December 31st, right? It could cover it for a quarter. Maybe you want to look at the quarterly changes. It could cover it for a month. It could cover it for a week. Get creative, right? But it's covering for a period of time that you're naming and you're trying to describe. Right? It typically shows your revenue or sales. So it shows gross revenue or total cash in. And then it's going to show total expenses or cash going out. And then at the very bottom, it's going to detail your profitability. Now, in a moment, we're going to talk about ratios, and I could go crazy talking about ratios and profit and loss. There's lots of them, right? Like net profit, gross profit margin. Like we could come up with some ideas of how you measure the financial health through the profit and loss statement. But we'll come back to ratios in a moment, okay? But that's the profit and loss statement. Now let's talk about balance sheet. Business owners like balance sheets, right? Sometimes I look at it. They don't find the full relevance of a balance sheet, but funny enough, this is going to be one of the first places that a lender or a banker is going to go to try to see how a business is going. Okay? So what it does, unlike that range of time or that period of time, right? It looks at the financial health of a business at a point in time. It's not a range, it's as of that date. Right, so as of the December 31st of 2021, how much cash did that bank have in the account? How much debt did they have on the books? Right? What was the equity or net worth of that business? That's the kind of conversation that the balance sheet has. So it's going to reflect the assets of the business. Where are those assets? Are they cash in the bank? Are they fixed assets, equipment, right? Maybe they're intangible, they're goodwill, right? Where are those assets? It's going to talk about the liabilities of the business. All right. And then, of course, there's a formula. I want everybody to understand the formula. It's assets equal liabilities plus retained earnings. And I feel like I'm speaking Greek, but when I explain it this way, hopefully you will get the point. Okay. I love analogies. I liken the balance sheet to having a party and having a piñata at your party. Okay, follow me here, okay? So when we show up to the party, right, and we see that piñata, do we want to go to the party with the piñata that has lots of candy in it and it's big and fat and you can tell it's weighing heavy on that string? Or do we want to go to the party where the piñata has already been busted open, right? It's just hanging there on a tattered string and there's no more candy in it. I think we'd all agree we want the fat piñata. Okay. So the balance sheet is going to tell us if there's more assets in the business than there are liabilities, right? Because if there's more liabilities in that business, there's more claims to ownership, right? Then we're the tattered piñata, right? It's already been busted. The candy's out, right? The candy or cash is gone. It's been robbed, all right? It's nothing there. That's what the balance sheet tells us. Hopefully there's more assets than liabilities. And just remember that there is that relationship between assets and liabilities, right? If you have less liabilities and more assets, that means your retained earnings or the value of the business is higher, okay? All right, so it's going to tell us how well that company has operated since it opened. That is what the retained earnings does. It tells us how profitable that business has been. When there's a negative retained earnings, it means the company's either young or has just been historically unprofitable. Okay? Remember, pinata effect. Okay, moving on. That third financial statement, it's that cash flow statement. And I started off saying that a lot of people never knew about this statement and they'd be just, in awe of what it tells you. A cash flow statement does a range of time as well, right? Similar to a profit and loss statement, but it details the movement of cash within the business. All right, like I have seen, you can see amazing things on these cash flow statements when you actually take the time to look at them. You can see how much their operating revenue was, right? And maybe their operating revenue wasn't positive. They didn't actually collect it. And you're looking at a profit and loss statement, and maybe they have something like accounts receivables, right? But they haven't collected the money on the accounts receivables. So it might show that they're profitable, but then when you hit that cash flow statement, you realize they haven't collected the money yet, and they have a negative cash flow, right? That's something you wouldn't necessarily know. So it's really important to look at that cash flow statement. That's almost like looking at your bank statement and being mindful of what you actually have in your hands as opposed to what somebody owes you. All right. So you'll see a detailed use of cash, and maybe, for instance, there's negative operating cash flow, but they've end up increasing their liabilities and they've taken that loan money to cover the negative losses. Right? That's one way to cover losses so you can keep operating. There's tons more, right? But that's the type of detail that's going to show up on a cash flow statement. So you can understand now why that's important for you to be able to see it yourself and understand the movement of cash. And you'll see clearly where you started in that period, what your cash balance was at the beginning of the period, right? And then how you've operated the business and what your cash balance is at the end of that period. Right. And you heard Brett earlier talk about one of the most valuable things. It's not hard being in business, right? You want to end the day with more money than you started the day. That's a good day. All right. So the cash flow balance, same way. You want to end with more cash than you started with, and you know you've done a good job. Okay. That was not too bad, right? Like, that's not rocket science. All of that typically comes out of a QuickBooks or Xero or any accounting system. You should be able to get those standard form reports. You just need to now start looking at them, right? That's challenging. You can't listen to the screaming employees. You got to make time for that report so that you can understand the trends. All right, so this is your little tip on how you review your financial statements, right? Because I'm going to be a big proponent. You got to look at your numbers before you walk in to that banker or lender, right? Or try to create the package or the forms that you need in order to have a good conversation. You got to know your numbers because that's where the added detail comes in. All right, so what do you need, right? If you're going to do this historical review, if you're going to have a good look in that rearview mirror, what should you be focusing on? All right, you're going to focus on the trends. You're going to take things like revenue, cost of goods sold. I laid them all out for you. Okay, you're going to look at those line items on that other slide, right? And you're going to look at the trends over those 3 years. Are they up? Are they down? Right? Why? Why are they up or down? What's your story? Look at it. You're the leader in that business. You know where that money went or didn't come in, right? What's happening? And then do those reports, like have an honest conversation with it. Do those reports tell your full story? I would wager that they don't. I would wager that there's a lot more shades of gray involved, and you need to bring out of the conversation additional details. Okay, example, let's say you weren't profitable, all right, and it wasn't because you didn't try or that you weren't making sales. Maybe materials went up, right? Or you had a hard time getting supplies in, right? And so that cut down on your profitability. Well, then you need to tell that story, and maybe you can show invoices for increased, you know, expenses for shipping, or there's detailed industry reports showing that, for instance, the car industry, the chips, you couldn't find the chips, you couldn't sell the cars, right? There might be other aspects of the support that really show that you're telling the right story, right? And that the numbers are temporary. There's other ways to look at it, right? But essentially you're providing a backup or proof to what you're saying or what you're trying to show. All right. Next, anytime you're borrowing money, right? If you're taking this package to a lender so that you can make sure you have everything you need to be able to tell them how you're going to spend the money that they're giving to you. Really important, right? Because it should match the story. If I walk into that banker and I'm like, I'm doing great. I'm making money hand over fist. I need to hire a new salesperson to keep up with the demand. My phone's ringing off the hook. And I need to hire this person to, you know, pick up the orders, right? And I come up with this elaborate story. And then if you look at my numbers, my sales have gone down, right? Why do I need to hire somebody when my sales are going down? It clearly doesn't claim that, right? I should be doing better with what I have, not adding to my expenses. Again, how are you going to use that money? What's that story? Does it match what the numbers are telling us? All right. Okay. I'm going to give you a concept. All right. And I laugh because I think of that movie Holes, right? If you've ever seen that movie, it's these young kids out in the desert. They're digging holes. And they don't know why they're digging the holes, right? They're just told to dig the holes. Later on, they figure it out. But are you digging holes, right? Or are you building bridges? Right? When you are asking for money, the lender wants to understand, are you really doing anything good with that money? Right? Is it going to something constructive that's going to improve the revenue and the business history in the future? Right? Or are you just covering up problems, just trying to shuffle one bad decision into another? Okay, so you need to be clear how you're going to use that money, and hopefully it's going to be for something constructive that will lead to more increased revenue or a higher profitability. You don't want to be digging the holes for no reason, okay? Okay, that wasn't so bad, right? We got through the first one. Good job. All right, let's keep it going. Let's talk about key financial details to support lenders. Right? So, it's the key. What's the key? So we heard about the basic package, right? But there might be more that needs to be provided. It's going to be unique to your own situation. So I'm going to start off by saying that lenders like details. They do, right? They like details. They may not care if your favorite color is blue. That might be more detail than they care, right? But understanding more about your business, yeah, that's something that they can get behind. All right. And so they like plans of action where you're telling them, look, I've researched information. I know what I'm talking about. I've put a lot of thought and energy into this, and I have a really good action plan, right? That's signs of intelligence and, good energy. And, if somebody has a detailed plan, oftentimes they know how to accomplish it, right? That's a good sign. All right. But we also understand that each business is different, right? And their aspect and how they're running that business is different. But every business deals with cash, right? That's the language of business is cash. All right. And so they're looking to understand the cash flow to understand the business to kind of follow along. All right. They're also looking for some really important key aspects. All right, and so we're going to follow up on this, but these are kind of the key aspects. It's going to be the ability to repay back the loan. Remember, I mentioned their number one goal is to get paid back, right? So they're looking to see whether or not that business has the ability to pay them back. All right, next they're looking for a history of a successful borrower, a successful business. All right, if I have, as a business owner, run 5 businesses into bankruptcy, right? Squandered all my money away, right? I'm probably not going to be the best risk that that banker wants to take, right? They are not going to look at me and think I have a history of being successful, right? But I've got to show success, and I may not be able to show success off of those most recent financial package, right? Maybe there's a sign of distress in there. Maybe my revenues have slipped or my expenses have increased. What additional paperwork or conversation can I have around success? What gives them confidence? All right. This is kind of hard, but I'm going to throw this one at you too. Lenders, they know that the world is not always exactly the way we see it, right? Reality is things happen, right? Pandemics show up out of nowhere. And so we've got to start preparing for the unknown, or what we call in this industry, the worst case scenario. So I'm going to tell you, they're going to make up a story about worst case for you. You have this rare opportunity at the very beginning to help them understand what worst case means to you. What is your definition of worst case? So you'll prepare that worst case scenario. Okay. And at the same time, because you're so detailed and you have a good action plan, you're hopefully thinking through potential risk for the business. And if they're an investor, risk to the investor. Okay, so you're going to think about that risk and try to figure out how you're going to mitigate it, remove the risk, reduce the risk, right? And I like to think about it this way. A lot of times to reduce the risk, it means that you're going to have to provide some of that capital into the project, right? The lender doesn't want to be the 100% of the skin in the game or 100% of the one that's risking their neck on the opportunity. All right, they don't want to be in the 100% of the investor. They're going to want to see where you're bringing some candy to the party, right? You're going to bring some money to the party to offset the risk so that there's a share in this. So providing some type of strong down payment, what we call capital injection, is important. Okay, so we kind of nailed it there, right? We talked about key aspects. We understand important aspects, ability to repay back, successful history, painting the picture of the worst case, understanding the risk, right? And understanding that, again, we've got to contribute to the business, right? Putting that strong down payment or capital injection. All right, so we're talking the language of the lenders. And in that way, right, we get to understand these key financial details through what we call ratios. Right, and when I say ratios, I feel like people are like transported back to like second or third grade, and they're sitting there trying to figure out how to add up, fractions and doing decimals. Please don't think that way. Like I don't want to take you down that road, especially if you didn't like those times. Ratios means relationships between numbers, right? And remember, numbers to us mean money. And I like money. I'm sure you like money too. Right? So we're going to talk about relationships between money, aspects of the money, and how we get the most out of it, right? The most knowledge out of it. So remember we talked about the ability to repay back the loan? Well, there's a ratio for that, right? How the lender looks at your ability to repay back the loan. And so what they look for is what we call the debt service coverage ratio, or DSCR for short. And if you want to look this up, Google it. All right, it's super easy to follow. You're looking at how much cash flow, like positive cash flow you have versus how much your repayments are. That's the relationship they're looking for, how much you have to repay back versus how much actual cash flow you have, right? And that's the relationship. Do you have enough cash flow coming in that you can pay your debts? Not bad, right? All right. History of a successful business. Remember, they're looking for trends. They're looking for multiple years of having positive cash flow to repay back the loan that you're trying to borrow, right? Or your debts. If you haven't been able to show the ability to pay off the loan in the last couple of years, they're going to be really slow. They're going to start to try to understand, how do you think you're going to be able to pay back the loan, right? And that may come from the future, which is that windshield we're about to talk about, right? But typically they're going to look for successful business on past performance for cash flow. All right, and then remember we talked about worst case scenario. There's something called discounted cash flow formula. It's not hard, right? But they're going to take your cash flow figure down a notch to see if you can still pay back your debts. Right? That's not hard to understand either. You can find the formula on Google too. But essentially, you're going to take whatever interest you have to repay, maybe it's 5%, right? And you're going to add 1% to it. And then you're essentially driving down the cash flow, right? And then still trying to show that you have the ability to repay back the loan. So you'll help figure out your worst case scenario for the lender. All right, and then remember we talked about reducing the risk, and I liken that to having skin in the game or a capital injection. Okay, so they're going to look to see whether or not you have enough assets compared to your liabilities, right? Typically, you want to have $2 in asset for every $1 of liability, a 2 to 1. So if there was a fire sale and you had to go to business, right, you would at least come out in a positive stand. You have more assets than liabilities. If they know that you can operate that way, that you have enough cash or assets to support that type of situation, you're going to reduce the risk for them, right? Now, another one too, because you hear this all the time, it's about down payment, right? Capital injection. Typically, they'll have that conversation with you by telling you the maximum amount of the total project they'll finance, which is never 100%, right? For example, it's pretty common to hear 80%. So you would have to come to the table with 20% of the need. They'll come to the table with the other 80, and the 20 and 80 together get you where you need to be. Okay? All right, that was a lot. How do you feel? You feel pretty good? Ratios are fun, right? They're just relationships between numbers, and that's money. We can figure out relationships between money. That's not a hard thing. I'm a big advocate of making sure that you know your numbers, right? So, again, review your own ratios. I gave you a few in this presentation. You'll have them. You can Google them if you need to, right? Be able to tell if you have strong numbers or poor numbers. Hopefully you can tell whether or not you can repay back the loan that you're trying to borrow, right? If your net income is less than the amount that you're asking for repayment for that loan, there's a problem. You want to figure that out before you go to the investor and you look kind of silly, right? All right. And then understanding when you're looking at these trends and you're looking at these ratios, how much risk the lender is actually taking on, right? Or how little risk the lender's taking on. Maybe you're a really good deal, right? Knowing that almost gives you a certain edge in the conversation, right? Or it helps you reframe the conversation so you can find your edge, right? Support documents, other cash flow, other conversations so you can get better, right? But ask yourself when you're thinking about that standard package, ask yourself if you've done your little analysis and you've looked at your trends, what type of information is going to make this conversation better, right? Or easier? What's going to have that show the right conversation, right? And then you're going to add that level of detail or support document to the package. All right, so that leads us into the next conversation, which is framing your funding needs with reports, okay? Because it's not just about that basic package that we talked about. There's more to the story, and you've got to connect additional details to the story based on what you're seeing. So we started off understanding the rearview mirror, right? The basic package, right? So you're going to reflect on those ratios. How strong was your past cash flow? Right? Is there too many existing debts, right? That's that quick ratio. Do you have a loan to value, the collateral value? Is that strong, right? And depending on your review, what are your areas of weakness or concern? What could the lender say about you, right? And then how do you get around that weakness, right? Be constructive, find the answers. How do you reduce the risk to the lender, right? Is there a way? Oftentimes there is, right? And then just making sure that you're being detailed to the conversation so you can show the stronger picture, because we know that these bankers or these lenders, they like detail, right? So you give them what they like, you help them feel comfortable, you help frame the information in a way that makes sense. We call that being compelling, right? And we get further down in the story of finding that funding. Every business is going to be different. In a minute, I'm going to give you some examples of how you could add additional support documentation to connect the story. All right, I'll give you some examples, but I want to take you through the 5 C's of credit. I'm sure you've heard this before, but you haven't heard it from me. Okay, so 5 C's of credit, it's kind of the end all be all for the commercial lending world. All right, so when they're doing their little credit review, they're lining you up in these 5 different categories, almost like grading you. And so as you're looking at your own numbers, right, you know what they're looking for in these 5 C's of credit. It helps you be prepared so you can really understand what support documentation or what needs to be included in the conversation. So I'm going to go over them real quick, and then I'm going to give you examples of the support documents, okay? All right, so capacity. Right, capacity is the ability to repay back the loan. That was number one. I told you that's what they want to see, that you can repay back the amount that you're borrowing, right? So the capacity or the cash flow to repay them back. That's number one. Number two is character. Right, remember we talked about experience, right? Experience talks louder than words. Have you been able to do this? Are you the kind of person that can be successful? How do we know that? How do you show that? Maybe it's a resume. Maybe it's the fact that you've sold or exited another building or business and sold it for X number of dollars. Or maybe it's because you've been in this business for 20 years and you've grown it from nothing to 10 million, right? How do you frame your character? Okay. Third is going to be collateral. So remember I mentioned loan to value, right? So if things get tough and the capacity or the cash flow goes, what's the secondary form of repayment for the lender? How are they going to get paid back? Right? So typically collateral is requested because they can sell off that collateral and then repay back the loan. Or you have the type of character to repay back that loan. Mm. Right, conditions. That's the kind of ball of wax we're in right now. Right? We're in this unknown world. Things are changing around us every day. Maybe the CDC will change again within the next few weeks, right? Everybody's hoping. But there are conditions happening in the economy, right? We got war in Europe. Conditions are happening that are impacting our world, our business. And so understanding the conditions around your industry and your business and being able to give good conversation about what you expect to happen and how you're monitoring that in your business is important, right? Conditions. And then, of course, capital. Capital is that down payment or equity injection. Are you asking for 100% from the lender? Is all the risk on them? Or are you sharing in that risk? Right? Okay. So remember the 5 C's of credit. Remember the basic package. And remember that as you are trying to have this conversation with the lender, you have the ability to add financial statements, right? Add bookkeeping that helps square up some of these concerns in those 5 C's of lending buckets. All right. Can you address all 5 of the C's in your documentation? Ooh, that's tough. Okay, so let's think about that, right? Maybe you don't have collateral listed. Maybe it's on your balance sheet, but you need more detail to understand what the collateral is because it's just in one lump sum, right? Maybe you're purchasing collateral through the use of proceeds. You need a new truck or you need a new heavy piece of equipment. You need to document what you're trying to purchase, the value of it, so you can have a good conversation with the lender. You see how that all works? 5 C's, understanding your own numbers, how you're mitigating that risk, right? Understanding your ratio. It helps you understand the conversation you're going into. All right, so how can you improve your reporting? I'm going to give you just a couple of samples, right? Accounts receivable aging. I know I'm throwing Greek at you here. All right, but that's another report. It's in their QuickBooks, it's in Zero, right? Maybe when you make a sell or you make revenue, you offer terms. You bill a company for your services or goods, right? And you wait for them to pay you. That's accounts receivable. That's money that's due to you. You performed. It's not quite cash in the bank, but it's just about as good, right? So you may need to show a history of how you're collecting your accounts receivables, all right? Maybe they've slowed down because companies are just slower at paying because of the economic conditions, right? So you may need to show that you need cash because you're waiting for your cash to show up. If that's what you're seeing on your trends, that would be a report that would support the conversation to help give more insight into what's happening. See how that works? Right, maybe your problem is that your cost of shipment, right? Cost of handling, it's increased. It's squeezing into your margins, right? You didn't anticipate it. You took these orders, you signed this contract ahead of all these conditions. Right now, you're just trying to, live up to what you agreed to do. You can't stop now, right? So now you've got some undue burdens, some undue expenses. And so how would you document that? You would start showing the invoices, right? You could show past invoice, current invoice. You could show the increase in the expenses. You could have a good conversation of how that's squeezing your margins. So you might not be a bad manager. You're just navigating through a terrible storm, right? All right, detailed collateral list. Maybe you know that there's risk in the future, right? And you're thinking that that lender's going to look in and say, what's my secondary form of repayment? What's my collateral? Maybe you've got collateral, it's just they can't see it, or it needs to be more detailed to understand the value of it, right? Detailed collateral lists, right? Maybe you need proof of a down payment. Maybe you're looking at that capital injection, right? And you want to show that you do have the money to live up to your 20% or whatever percentage. So showing bank statements, showing you've got the money, that says a lot about you as a business owner that you're ready to go. You're actually prepared. Okay? Maybe, just maybe, things are changing on the horizon and you're taking advantage of a great opportunity, but you need capital to make that opportunity happen. And so you're going to be basing repayment of this loan in the future, right? And you're going to be looking through that windshield at the future. So that would take you into a projection conversation. All right. And then maybe the character is a concern. Maybe you don't have all the skill sets you need in order to operate the business. Maybe there's a key person you're bringing on. Maybe it's a CFO or a chief marketing officer or something like that, right? You can bring in resumes for key employees that will help you with the character conversation. Whatever it is after you've done your review, right? You got to get creative. You got to think how you have an intelligent conversation, how you support your number story. And it can be different. It can be different. You just have to tell your story and be detailed, right? Because that's what the lenders want. All right, so you have been so good. Just going to give you an idea, not a whole lot longer. Hang in here with me, all right? We've got one last topic to explore, and it's really talking about the future. So in our car analogy, right, we're not driving the car by looking straight in that rearview mirror. We're looking through the windshield too, right? So this is our windshield talking about the future and using what we call cash flow projections. All right, so projections means we're taking guesses about the future, right? And we call those guesses assumptions. Assumptions are really well articulated understandings of what we anticipate happening, right? How much money we're going to make or how much money we're going to spend for that opportunity. So you have to ask yourself when you're doing your projections, what are your goals for revenue, right? What are your goals for expenses, or what is your budget for operating that business? Right, the tough part, remember the 5 C's. What are the conditions that are going to impact that business? Right, and then how accurate are you? How much do you know about operating the business and those assumptions or guesses you're making, right? And then hopefully you can follow into those assumptions to understand them. But as you are going forward, right, looking through the windshield, driving your car, you should also document your assumptions. Document the conversation because again that gives strength, it gives certainty that you know what you're talking about. All right, so when we are going through this future conversation, we have to ask ourselves, are we a good investment? Sometimes it's tough, right? But we got to make sure that we're keeping the crust of the whole conversation first and foremost, right? Do we have the cash flow projected to be profitable? You have to come up with this yourself. You'll see this. You certainly don't want to invest in a business time, energy, and resources when you know it's not going to be profitable. Same thing for the investor, right? When will that company break even, or when will it turn a profit? That's an important aspect, right? You'll learn that through the projections. And can you turn a profit and still repay back the loan? Sometimes the answer is no. You've got to be able to be comfortable with managing that debt and repaying it. And then, since we're looking in the future, right, and we're coming up with some guesses or assumptions, we should also create that worst case scenario. What if things don't end up the way we guess, right? What is that worst case scenario, right? And then how do we know when we're getting there, right? That's that financial dashboard, right? And then we have to connect the money, right? So how can we show that the money that we're borrowing in that loan is going to support the future, right? Maybe that's the equipment we're purchasing. Maybe it's the new employees that we're hiring. We should be able to connect the loan to the future cash flow. Whew. Well, if that was a lot, it was. It was, and I'm really happy for your patience, right? You've been very gracious. Hopefully, you're putting any questions in the chat box because we're about to get to those. But I just want to kind of end with this conversation about projections being an art. All right. It really is. Projections in art. And so you're going to feel like you're taking a stab in the dark when you start doing this. Okay. It's like you're throwing darts blind. You don't know where they're going to land, but you're going to get better. You're going to better the more times you do it. I say seasoned business owners, they live on projections because they understand the leadership aspect that's required in order to make the future happen. And that's the world they're in. They're not looking through the rearview mirror, right? They're looking forward. In fact, I call that the rolling 120, right? Where they're looking a quarter in the future. They're making things happen a quarter in the future. They're seeing their cash flow 3 months ahead of where it is today, and they're preparing for any downturns, right? And they're looking for those assumptions, those guesses to see if they're on target or if they're off. Because if they're off, they're on that worst case, right? So they've already thought about what they need to do and they're leading to it. All right. So I think the art is seeing future trends, right? And learning how to correct the ship or correct the car so that you can navigate around the issues ahead of you. And good leaders, they understand that they help stand next to others to see that future, right? That's what makes a good leader is they're able to encourage and motivate and bring people there to see the same vision. And when you have the ability to be good at projections and to be good at understanding your number story, you can really paint that picture for other people to see. And the best part about this is that when you find a good lending relationship and you have mastered the art of projections, you are always living and focusing that lending conversation on the future and making opportunities happen because hopefully you've already gotten past the initial loan and they trust you, right? Character. And they see that you've got the ability to create more wealth. They like what you're doing, right? And you can easily find a rhythm with creating in the future with that lender. All right, so here we are. So in summary, financial bookkeeping is about understanding your story. Nobody's going to tell the story but you, right? We talked about that. Your numbers are going to tell a story. You know, you've lived and breathed those numbers. They're expecting you to be able to understand and to lead, right? You're going to share progress reports with your lenders, right? That's how that works. Oftentimes it's living in the future. It's the art of the forecast, right? And just owning your key story, owning the aspects of the conversation that are uncomfortable, supporting those aspects with additional detail because we know that's what that stereotypical lender needs, right? And then tracking your progress against those assumptions. So I'm going to end on, remember the key financials that we talked about. I gave those to you earlier, right? Remember to look in the rearview mirror, look in your windshield, right? And then hopefully get to where you need to go. I hope that was fun. My name's Rebecca Schultz. I love money. I really, really do. And I love talking about money. So thank you for listening to me today. If you have questions that weren't answered by the presentation, happy to do that for you. Just let me know. And with that, let's go ahead and end the screen sharing and answer whatever questions came through the chat.
Well done, and thank you, thank you, thank you. Oh my gosh, some things there that some experienced people didn't even know, just broken down in a nice way. Thank you. If you have questions, please put them in the chat, as she said, or you can unmute yourself right after my question, because since I'm the host, I get to be the first person to ask a question. I just said so. So one of the questions that I do have is, if somebody is actually needing some collateral, can they use something they're actually using the money for as that collateral?
Yeah, it's a good conversation. Some lenders have different takes on that, but in most cases, yes, especially if the lender is using an SBA loan, which, I'm not going to give a whole spiel on SBA loans, but just kind of give a little color to it. The government, through the Small Business Administration, offers different type of loan programs to support business owners where they may not normally get a yes from a lender, and that may be for collateral reasons, right? Maybe there's lack of collateral. So the SBA would guarantee repayment to the lender, which offsets that risk, right? It kind of gives that little assurance. But yes, in an SBA loan program, they will look at available collateral within the business that they can use and leverage, right? They'll take a lien against it, almost like they're taking a title against a car. They'll take a lien against it, and they'll use that as additional collateral for the loan. They'll look at it as a combined view. Now, where I feel like I should make sure that we're being very clear on the topic there. Um, some lenders will always want a cash injection, right? So SBA loans tend to look in the past. Some lenders always want a capital injection because they never want to be in a situation where they're taking on collateral that has little value, right? And then that puts them in a higher risk category. So it takes a conversation with the lender to understand where their policies or guidelines fall. It could go either way. Also, too, right? I feel like I have to fully disclose that. Um, Collateral that is not being used for the business actively, like I had a deal not too long ago, lovely couple, right? But they were building construction on raw land, and so they bought some of the earth movers and the diggers, right? They took their cash, put in the earth movers and diggers, but the business that they were building is completely different. And so they said, hey, I'll leverage the earth movers and the diggers as collateral for the conversation. And the lender was like, nope, not having it. Because that asset, even though it was a hard asset, right? It had nothing to do with the operating business. And therefore, it had a little value as far as converting their cash assets into more cash assets. Also, too, like, remember they take collateral. It could have bonded it to a loan and they wouldn't have been able to sell or transfer the collateral if in fact the lender did take the lien against it. So you have to be a little careful on that conversation,
Okay.
ask questions.
Thank you for being so detailed about it. Another question, in what circumstances might a lender take less cash injection? What kind of qualifications might that require?
Good one. If they really, really like your business industry and they feel really comfortable with it, that's one, right? If you have a strong history with them, and they already have collateral in another way, right? That could be through cross collateralization, we call it. That might reduce it. If SBA is, they're getting an SBA guarantee instead of doing, let's say, a conventional 20% down payment, right, or cash injection, they may, with an SBA loan, allow as little as 10%. So it just depends on the type of loan product, the policy, the discussion, what kind of relationship you already have with them. So I know that's not, you wanted like very specific, but it really is a negotiation process.
Okay, thank you. That was a good question. Thank you. If there's any other questions, or if you would like to unmic yourself and ask directly, please feel free to do so at this time. I'm guessing you answered everybody's questions, and there's been a couple people that asked for something. I'm going to go ahead and put right here in the chat right now. Yes, those of you who were late, go to that link in the chat and you can get Rebecca's full presentation today and the one she's done before that, prior to. And in fact, you can get our entire series of over 100 videos for helping to train entrepreneurs and small business owners. And you can find many of those by Rebecca Schultz right there in that link. So for those of you who were asking about it, that got here a little bit late, yes, no worries. Just give us a little time to upload it and we'll be happy to do that. Any other questions at this time or any closing remarks from Miss Rebecca?
Well, you know what? Thanks for having me out, one, for the team at the SBDC, but also those joining. Hopefully, there was some value in the conversation. I feel like it's taken me an entire career to really master this concept and realize that one has the power to drive their narrative and not just sit on the defensive. Right? Just waiting for the questions, not knowing. You really have the ability through documentation and through understanding your own history to support and drive what you want, right? So take control of the conversation and the narrative and realize those lenders, those bankers, they're really trying to support you. It's just oftentimes we don't give them everything they need in order to support us. So that's really on us. So take control of your story, your number story, get good with it. If you need support, reach out to your SBDC advisors, and hopefully we'll see you soon.
Great. Thank you so much, Rebecca. I appreciate it. And we'll always take those five C's with us there to make sure that we get everything going. Thank you so much. Let me share this with everybody real quick. We have some more upcoming fun stuff coming along for you that I want to just tell you about. Hiring Smart with CJ Pettit on the 9th, and on the 10th, Bank Rules in QuickBooks by Stacy Kildall. And on March 22nd, Taking the Cryptic Out of Cryptocurrency by Miss Rebecca Schultz. I personally am looking forward to that one because I don't get it. And it's okay if I admit it. I don't know everything, but I don't get it. So I'm looking forward to seeing that one, Rebecca. And
Okay.
also on the 22nd, Building a High Quality Email List Part 1 with Ashley Cook, and Budgets in QuickBooks by Stacy Kildall again on the 24th. So these are some of the upcoming things. And if you want to look a little further into the future, you can take that little QR code and it'll take you straight to the site for any of the upcoming webinars we may have available to you at no cost. And we want you to feel free to be able to go there, or you can go straight to sbdc.nctc.edu, our website, and we'll be happy to schedule time with you with an advisor to sit down and talk to you about your business and your potential needs directly related to your business. So we look forward to all the upcoming fun that's coming up. We want to thank a few people that make this happen. Of course, the Small Business Administration, the state of Texas, North Texas SBDC Regional Office, and North Central Texas College for all coming together to make this available for you. We thank you all for joining us, and we look forward to seeing you next time. And this will conclude our webinar for today. Have an amazing week, everybody.
You too. Thank you. Bye.
Bye.